All right, awesome. So thank you everyone who has joined. And if you're joining right now, welcome to the webinar. My name is Ruth Grover. I am our VP of Partnerships over at ezyCollect. I'm joined today with Laura Walker, who's our Senior AE and Sales Lead. We also have Joseph Drohan from Brook Air, and we have Dinah Lee Garcia from UBT. And today's presentation is on identifying credit risks and how to spot red flags during customer onboarding. So we're going to start the webinar now. First thing first, I'm going to hand over to Dinah Lee to talk a little bit about the partnership between UBT and ezyCollect.
Thanks, Ro. So before we dive into the platform, I just wanted to give a quick minute to highlight the strong partnership between UBT and ezyCollect. We've been a partner for over 7 years now. During that time, we've seen more than 100 businesses join the platform. This partnership has generated over $500,000 back to UBT. And some of the businesses currently are using ezyCollect include Brook Air, Schaumburg Specialties, and Protecta. Over to you, Ro.
Awesome. Thanks, Dinah Lee. And yeah, just to kind of echo what you're saying, yeah, it's been a great partnership. It spans across Australia, New Zealand, the US, Canada. And yeah, we're just really grateful to be able to work with such amazing companies that are part of the UBT community. Fantastic. Laura, can you move to the next slide for me? Brilliant. So guys, I'm going to give you a very quick overview of what we're going to be covering today. So we have three major things that we're going to be talking about. The first thing is we're going to be talking to Joe from Brook Air and kind of understanding a little bit about how he does credit risk monitoring in practice. So he's going to give us a bit of an experience as well as talk through how he's been using the ezyCollect tool and what he would recommend for businesses to do. Immediately after that, we're going to be talking about some of the common red flags and best practices. That's where Laura Walker and Joe are both going to have a bit more of a chat and go through some of the issues that you would see whenever you're doing a customer onboarding, what to look out for, and some of the best things to do in order to make sure that customer onboarding is smooth and efficient. And then finally, we're going to end the webinar with going through some of the tools available for UBT members. So these are things that UBT members can actively use as you know, from ezyCollect, that are going to help you with customer onboarding and kind of just mitigating credit risk. So without further ado, I'm going to hand over to Laura to take you guys through everything.
Awesome. Thank you, Rohit, and hello, everyone. So I'm here today with Joe Drohan. He's got some amazing wisdom to share with us. I first met him, I think, a year ago, and he's using some of the ezyCollect tools for credit onboarding. I guess to start off, Joe, maybe can you tell us a little bit about your story at Brook Air, what you do, and how you came to work there?
Sure. So Brook Air is a filter manufacturer and distributor. It sells to about 1,500 active customers and about another 1,000 prospects on top of that. And we sell mostly in the North Atlantic states, 16 states, and a little bit of Canada. I've been here about 3.5 years. I got here and I came here because I thought it was a good growth story. They've almost tripled the size of the company in the time that I've been here. It's got a lot of good things, good attributes, got an excellent customer base. Frankly, customers that pay, not a lot of customers who leave. It's got a very strong customer service component. A big aspect of the customer service component is a next day delivery option. So folks can have their filters at their job sites for the next day. But it was a growth story, and I wanted the opportunity to be a part of it as it continued to grow and to, frankly, find solutions like we did with ezyCollect to help us create a structure that allowed the company to continue to grow beyond the 1,200 current customers and to something even bigger. So it's been a good 3.5 years, and the growth has materialized, and ezyCollect has been a part of that growth story.
Thanks for that. Yeah, so I guess maybe to take a quick step back so that we understand the context around the credit onboarding experience that you have. tell me a bit about like your typical customers. How do they find Brook Air? And what's a bit about the sales process? When does credit checks become or credit insurance become a part of the conversation?
So we have 9 full-time engaged sales staff. A couple of the equity owners sell as well. So they're actively looking at new customers and new territories, new regions. And we also have a website that people can come in through. But typically, they will find different verticals of customers. So we have data centers or hospitals. We have some pharmaceutical companies, government buildings, some real estate managers, and some smaller HVAC companies or builders, all of which have different need for filters. But typically, the sales staff will bring in a new customer. That customer will give some indication as to what they want their first order size to be. They will get, once we know who they are, they'll get a credit application from us. That credit application used to come back on paper. Over the last 3 months, it's been digitized. There's now a workflow tool that they can use to complete the credit app. But typically, that credit app will give us some background information into how we want to start with them, what their terms might be, how much credit we can give them, and really a lot of reference information, trade references, bank references, several names that we need to get to, if we need to contact the company. But the credit app is really the substitute for what I would say is our contract that they sign, indicating that they accept our terms and we will extend, some amount of credit to them to start buying filters from us. But typically, they're going to come to us through those 9 salespeople or a member of the ownership.
Yep. And I remember you saying that before you started working with ezyCollect that you had credit insurance as your main sort of way of mitigating credit risk. Can you tell us a bit about that and what the pros and cons of that was?
Yeah. So we had a large global bank who had an accounts receivable insurance platform underwriting our insurance risk. It was not an inexpensive venture. And it was really a twofold engagement with this global bank. Number one is they underwrote AR risks. So if we had a default or a bankruptcy, that was covered under their insurance policy. After we met a certain deductible, they would reimburse us for that loss. And the second part of it was so that they can understand their own underwriting risk. They would create a dollar value or an underwriting amount that they thought that they could insure the customer for. We defaulted to their underwriting value as the starting point for us to assign credit to all new customers. As an example, the typical, I would say, fallback credit terms were for $5,000 in initial credit and 30 days. That became probably for 80% of the customers what we initially gave out as starting credit when we were partnered with the global bank. If customers wanted more than that, the bank would do a bit more credit investigation. This global bank happened to have a very large credit, corporate credit, consumer credit. They were a big bank and they understood how to measure credit risk. So if they wanted more than the initial allocation, the bank would take a look at what their initial exposure was and continue to move it up as they got more information on them. So that's how we started. We migrated over to UBT. I actually had called, not to UBT, to ezyCollect. I had called UBT to ask their input as to whether or not somebody could help us with underwriting. We wanted to undertake the underwriting ourselves. We felt like the cost of the premium through the AR insurer was prohibitive, that we were having difficulty recovering any claims against it. And we made a decision as an entity to go self-insured, which meant we were doing our own underwriting and assuming our own credit risk at that point. That was probably around when I started to talk to Laura. And we now use the ezyCollect tool to establish what the credit limits and the underwriting terms are for each one of the clients who come in. It's not only new clients, it's existing clients who may either fall behind or have their account go on hold because they're late.
Yeah, wonderful. Thank you for that. So can you just briefly talk about your experience with ezyCollect so far?
Yeah, it's been pretty straightforward. We have probably 4 people in the organization that use it. We have a young professional who's in charge of all of the onboarding, does all of the credit monitoring, all of the credit risk work for us. When a salesperson has either a new credit app or an old client whose filters are being held up, they'll call, his name is Caleb, they'll call Caleb to do a look onto ezyCollect to see where they stand in terms of how they're being rated and ranked, and whether or not there's any adverse events or hits against their credit rating. But the product itself and the ability to use it has not been that painful. It was maybe a half an hour demo in terms of what to look at and how to get onboarded, and we've got a handful of users who are using it. So I would say there wasn't a lot of friction around using the app, and we're kind of anxious, frankly, to see the rest of the integration, with our CRM product, with NetSuite. But at this point, it's been very helpful, both in terms of expediency and being cost effective to help us start to assign credit to these people on our own.
Wonderful. Yeah. Well, I'm glad to hear it, and yeah, don't worry, the NetSuite integration is coming soon.
Okay.
So now let's pivot a little bit and talk about sort of high level some of the red flags and best practices associated with credit risk onboarding. So we're going to start with some of the red flags and things that you might, I guess, signs that a business might be not the best credit risk, or that you might want to start with a lower credit limit. So some of these red flags I'm going to be talking about from experiences that I've had, but I'll also be talking to you, Joe, about some of your experiences. So let's get started. So I'd say one of the biggest red flags is a history of frequent late payments. So I know I've spoken to hundreds of accounts receivable businesses during my time as a salesperson at ezyCollect, and there's a common perception in a lot of industries that late payments is the norm in certain industries, like construction supply, where it's like, we get paid late because our customers themselves are waiting to get paid, or really big customers are always going to pay late. You just got to have to, I guess, manage your cash flow in such a way that takes that into account. So I guess I'm going to ask you, Joe, like, in your experience, how true is that perception that it's normal for businesses to pay late? And what do you think of that?
Well, I think the perception is real. If you allow customers to pay late, they will pay late. Late payments, I would say at Brookhair, are a bit of an exception. We put a lot of emphasis on keeping the aging as current as possible. We send out statements once a week. We do follow-up calls routinely. If our AR staff is not getting a positive response back, it gets escalated. We will put accounts on hold, meaning they will not get filters until they bring the account current. Our customers know that the contract with us is we will deliver filters the next day. We would like to be paid within the window of what the agreed upon terms are in the beginning. We have exceptions. We do have customers that I would say are not strict about meeting the terms. To be honest with you, those are customers that we work harder at in terms of not giving them probably the same favorable discounts as other customers might get. But by and large, our entire focus is on keeping the AR in the current buckets and aggressively going after customers who are beyond terms or beyond. The cutoff for us is 60 days. If a customer hits 60 days, that's a customer that's beyond terms for us. And the organization puts a lot of emphasis on bringing that back current.
Yeah, that makes complete sense. So one of the examples here of how to know whether someone's a late payer before you actually onboard them is if in a credit report it contains data on trade payment history. And so in this example here, we can see that there's a high percentage that are paid late. Aside from using a credit report or this kind of thing, is there any other way that you could get signals that someone might be a late payer before they actually start trading with you?
They're signals, but they're not definitive, Laura. So the best is a brief experience. So if you've got a new customer with you for 60 days, that'll give you probably enough early insight into what their payment history might be like. But prior to sending out the first order, other than um, a credit report, you could look up trade references, but trade references aren't going to be totally forthcoming, especially if they've got a bad history with somebody. So we don't put a whole lot of weight into trade references. So what we do is we start new customers relatively small and keep them relatively current until they've created a payment history that we think is dependable. One of the signals to us that we get uncomfortable with is if either they don't sign the credit app, which goes to them as one of the first steps, or if they start to strike out certain clauses or rewrite the credit app. The credit app, as I said earlier, is effectively our purchasing contract. It tells them what our terms are, that we protect our intellectual property, that they promise to abide by what our terms might be. So if they start to push back on the credit app in the beginning, that's a red flag. If in the first 60 days, if they're not meeting their terms, that's a red flag. But by and large, what we'll do is start to slow down the delivery of product if we think that they're not meeting their terms of the initial agreement.
Yeah, no, I mean, you've kind of also started going into the best practices thing. So I really appreciate that. And we'll definitely get more into that a little bit later as well. So another one of the red flags that we come across is length of operation. Of course, a new startup business is at a higher risk of failure than one that's more established. But one of the things you told me about, Joe, that was actually a learning experience for me was the fact that a lot of businesses will reincorporate in order to try and hide bad payment history. So can you tell me a bit more about your experience with reincorporated businesses and why are they high risk?
It typically happens with the smaller customers, maybe HVAC contractors or smaller contractors, where they might file for bankruptcy, they might go through a dissolution. But what you'll see is in an effort to avoid debts, they will either reincorporate or they'll go through some type of either acquisition or some new corporate enterprise. We have the same principles and the same staff people and maybe even the same underlying customer base. And they'll come up to us and ask us for the same terms. We don't typically give the same terms to a new reincorporated company that we may have to an existing company. There's no credit history. We can't pursue them legally under a new federal ID number if they've reincorporated. So when a company comes to us who with a new launch who's reincorporated with the same customers, the same product, the same address, we move rather slowly with them. We will give them initial credit, but it'll probably be the typical 5,000 in 30 days, and then we'll watch them closely for the first 60 days. But by and large, we want to A, make sure that we got paid from the predecessor company, and B, that they're not looking to establish or score new credit, under the legal protection of a new entity. So we're not negative about the reincorporation, but it'll just raise some additional due diligence that we want to do about why former principals or former managers reincorporated under a new umbrella. So they could be high risk. They could be absolutely fine, but we'll watch them until they get some runway with us, until we've had some history with us.
Yeah, so aside from you recognizing that someone's reincorporated because you've met them before under a different entity, if someone comes to you for the first time and you've never really met them or interacted with them before, is there a way that you can tell that they're reincorporated?
No, I mean, we do Google searches if we find it unusual, but beyond that, we're not doing any legal search. We're not doing a LexisNexis. We're not checking principals against what other companies they might own. It's a bit of a red herring if you go down that rabbit hole a bit in terms of trying to get connections. There could be entities that own 6 or 7 companies that may or not be connected to the entity that's seeking credit from us. So we don't do the work around matching the principals to any of their predecessor companies, as much as we do it with somebody who's looking to buy new filters, who's coming to us with a new tax ID number and reincorporated. So, I mean, that's what we do now. We haven't been hurt too badly by that. So, if we find that there's any softness in that approach, we'll go back. But, for now, we're taking, I would say, a pretty stiff look around the reincorporated entities. But, people that have come out of other companies, we're not looking at what other entities they might own.
Yeah, that makes sense. Yes, I would have thought, and I guess the way you've explained it makes a lot of sense. Like I would have thought, oh yes, you can go into a credit report and see what other businesses they've had, but like you say, those businesses might be nothing to do with this one. So yeah, it's a good point that you
Right.
shouldn't go too far down the rabbit hole on that.
Right.
So from you've already touched a little bit on this. So evasiveness and just the way that a business might communicate with you can sometimes identify some, I guess, something unusual about them that means that, again, it's not necessarily that they are a bad business or that they're a high risk, but it's one of those little data points that you use for your due diligence. So you were saying before, Joe, about people wanting to strike out certain terms and conditions in a credit application or being unwilling to complete a credit application. What are the typical terms that they're trying to get out of?
Well, they don't want to agree to the term, but what I typically see when people strike it out is they don't want to be held to the terms that we're providing, meaning legally held. So the credit app, it requires their agreement and their signature on it that says, I promise to pay you in 30 days, and I promise to, that I'll repay, up to a credit limit of 5,000, and I know you have full recourse. Sometimes they'll strike that out because they don't want us chasing them if they get to 60 or 90 or 180 days. So, what they're doing, occasionally is they're trying to run from our ability to perfect our claim against what they've agreed to in the credit app. So if they strike it out, and some have, it's a signal to me that they don't want to be held to what the standard terms are. You know, Typically that's the most common thing that they'll strike out in the credit app. Occasionally they don't want to provide a trade reference. That's a little bit of a trade reference, but what they're really doing is trying to strike out what we're doing to perfect our claim and to get our money downstream if they're not paying us.
Yeah, yeah, no, that would definitely be a worry. So, this is an interesting one here. So this is one I actually have personal experience with. So ezyCollect itself also uses our own credit onboarding forms for our own new customers. And because we also offer payment solutions, we often get like fraudulent businesses coming to us wanting to use us for money laundering. And fortunately, it's actually quite easy to spot when they're fake. And so sometimes, they'll come claiming to be like, let's say like usconcretesupply.com is the real business name and the real URL of a legitimate business, and they will take the name of the real owner of the business on LinkedIn, and then they'll have a slightly different email domain than the real one. So it might be usconcretesupply.net or like us-concretesupply.com. And if you're not careful, you might think, oh, it's the real one, get excited because they want to sign up immediately. And but fortunately, ezyCollect also has a good internal risk process. So I've seen it flagged enough times that now I recognize the signs, and I find it quite fun to sometimes go on a bit of a sleuthing mission and finding out who's really behind it. I guess, Joe, do you ever find that in your industry that you have people trying to spoof real businesses?
Yes, but not through the customer portals, not through the customer websites. We see it more, frankly, trying to come in through email. That they may say, what they'll do is they'll get somebody's name who works here, and they say, I'm Laura Walker. Joe, can you change my direct deposit details? And we know right away it didn't come from Laura Walker. So we'll see that from time to time. We've not done that or been susceptible to it. We do validate the websites. We have not seen a breach or any type of phishing event that would come through the customer portals. And remember, a lot of what we're doing are larger entities, and the hospitals, their schools, their governments. Not that people can't replicate either the websites or the identities, but we've not seen a lot of that coming through the sales process. But we do validate the websites, and their folks can come through our website as well, and they'll be validated that way. But not as you're identifying it here, Laura. We don't see too much fraud or scam coming through any of the customers or any of the customer websites.
Yeah, I guess that makes sense based on your industry. It's probably quite specific to us as a payment processor that we get quite a lot of that. One thing though, from a fraud perspective for especially supplying to the construction industry, I've seen a lot of construction businesses or suppliers to construction businesses have like stolen cards being used to try and purchase stuff for resale. And then there's a chargeback when the original owner of that card recognizes the transaction. And then the thief has gotten away with $5,000 worth of product that they're going to resell. I don't know if that's something that you've ever encountered at Brook Air, Joe.
No, although we use credit card intermediaries that do a lot of the fraud protection for us before they'll issue the approval. So if a card is either stolen or fraudulent, it typically does not get authorized, and it does not get charged. So we don't see a lot of stolen cards. We see a lot of virtual cards or single-use cards that customers are now inclined towards, where they'll give us the value of the invoice on a credit card, through their bank. They're not fraudulent, they're absolutely legitimate, and they'll come that way. But if there is fraud, it typically is filtered or caught by the credit card intermediary, and it doesn't make it as far as our process.
Yeah, that makes sense. So now let's talk about some of the best practices associated with having a strong credit onboarding process. So we've already touched on this a little bit. You mentioned that you've been using a digital credit application for about 3 months now, Joe. So I know that you're now using ezyCollect one, but you were also using JotForm before us, and then you were using paper before that. So maybe to start with, what made you switch from a paper form to digital?
We wanted to standardize the credit collection process, the data collection process, so we could start over time to evaluate the responses that we're getting and whether or not there was a pattern on some of the defaults or late payments based on the data they were giving us up front. We wanted to make life a little easier for the customer base too, to do a digital form online where they can use a digital signature and submit it that way rather than signing a piece of paper and PDFing it. Was really the way to get, I believe, better compliance and better adoption from the customer base. So we have an overall strategy at Brook Air where we try to make everything to digitize the customer experience a lot more advanced and a lot easier and faster on behalf of the customer. We also did it with an eye towards monitoring credit on a real-time basis. So if a new company comes in and I take either a paper credit application or a digital credit application, a year from now their credit rating could be different. It could be better, it could be worse. And with ezyCollect, we have the ability to get real-time information in terms of how hits are coming to the credit sites, what's going on with CreditSafe or some of the other agencies. So we wanted the ability to see, is there a new bankruptcy? Is there a default that somebody had that got registered with, one of the eight? So we wanted the ability to have real-time credit monitoring, and we felt that the ability to do that from the front end on the credit app process and on an ongoing basis was the best way to start modifying that. So we're trying to get away from customers submitting paper. They still do. But more and more are adopting the digitized credit app. And so far, the adoption, I'd say, has been pretty good. Not a lot of complaints or not a lot of pushback on it at all.
Yeah, I definitely think it's beneficial both to the customer and also to you because yeah, it's easier for them, less friction, but also they can't strike out terms in a digital credit application.
Right.
It's like you take what you get. So you also mentioned this briefly. So um, I think you said that your sort of starting terms is $5,000 30 days. Is that given to all of your customers, or do you have exceptions to that?
There are exceptions. Somebody with bad credit might be asked to pay with a credit card in the beginning until we give them any credit at all. Um, Larger entities, with a good credit history will come in. We have people ask for as much as 150,000 to start. Um, so, but it is typical for us to start with the 5,000. It can move quickly if we see a good 3 to 6 months of payment history. We'll start to increase it. If they have big orders that want to come through, we'll allow the order to go through, but we'll leave the lower credit limit in place and then increase it over time. But we toggle it, and what we mean by that is we look at the initial payment and ordering activity to see if it's sufficient, and we'll continue to move it if we think the customer is a good partner and is paying over time. We don't want the credit process to have a chilling effect on the sales process. And there's always a little bit of this dynamic where sales wants to sell, and we want to collect. So, somewhere in the middle, you got to give sales the latitude to be able to tell customers they've got credit. You've got to have the latitude to allow customers to have the credit that they need. But you've got to be prudent about how you're underwriting and issuing credit to people. That money has to get collected, and it costs money to follow it. So it's a pretty good rule that we've adopted, and we'll stay with it until, we find that it's not sufficient for our needs. But, for roughly 12 to 1,500 active customers, it's worked fairly well so far.
Yeah, and you mentioned that when you start someone off small, that you're doing a lot more, I suppose, monitoring of them. Can you tell me like what that looks like? How frequent are we talking? Do you review them every week or every month?
Now, we review them monthly. The AR aging is in monthly buckets. It's current and 30 to 60 and 60 to 90, the same as everybody I'm sure who's on the call is doing. So we look at the aging several times a day, and we look at new people to the aging. We look at acceptance to the aging. So I will look at the 30 to 60 aging bucket to see if any new clients have aged into it. If somebody gets into the 60-day bucket, the AR team calls them. Um, our strict religion here is to keep the aging current. If somebody hits 60 days, that's a failure, either on their part or on our part. Um, but we do look at customers who enter either the 30 or the 60-day bucket. I'll go back, I'll look at every piece of communication, whether or not they're getting statements. Do we have the statements going to the right address? Do we have the follow-up going to the right address? Are we doing the phone calls to the right phone number? Occasionally get an alignment problem. What that means is you don't have the right email address or the right phone numbers, and invoices might be going to the wrong place. But if the invoices are aligned properly and the phone calls are going to the right place, then you may have to put the account on hold until they understand that they've got to pay for these within the terms that they agreed to up front.
Yeah, I mean, it sounds like a very rigorous process, so it makes sense that it's been that successful. Now, you mentioned that you don't particularly think trade references are that important, but you still get them. I know you told me the other day that you still do get every customer to give you trade references. So even if you don't check them, why is it important for them to actually give them to you anyway?
Well, I want to see that they've actually got trade references that they'll provide, first of all. I want to see a willingness for them to be transparent and to give us full disclosure. And I want the option to call a trade reference, in the event that we're not getting paid or we think that they're having difficulty. We want the optionality to call them. It wouldn't be a good use of my staff's time to call trade references in the beginning. I do get calls, and I try to give as honest a trade reference as we can give. We don't try to give bad references, but if you have a difficult client, it's not going to surface, from a trade reference. They're not going to tell you that somebody owes them money or that they're late. It would be unusual. The credit reporting modules, will be far better at telling you when people are days beyond terms, or, if they've got a dollar value that's outstanding than a trade. But we do want to collect them and retain them the same way we do it with bank references, just to see that they're going to be transparent and come forward with us, meaning be forthcoming with us in terms of providing these partners to us.
Yeah. Yeah, that makes sense. So do you ever call them, like once you've seen that a customer is a bad payer or is having problems, is that when you might call them?
I have, but it's been infrequent. I'll call a trade reference if I'm not getting a response from a direct customer. So we've had customers who go radio silent on us, who owe us money, who aren't responding to the AR follow-up, and I make the calls if it gets to a certain point myself. So if I feel like a customer is gone underground, meaning they've cut off all communication, I will call a trade reference to see if they're still in contact with them. I may or may not get a frank response, but I'll try to ferret out whether or not they're paying other customers or not. But typically, once they go underground and they stop responding to us, we'll pay very, very close attention and contemplate, sending it to collection or sending it, to the attorneys.
Yeah, that makes sense. So now that you're using ezyCollect for credit checking, one of the things that we provide is a credit report, and this can be used for both new customers but also existing customers. And a credit report contains a lot of information. So are there particular things that you look for in a credit report? Like, do you read the whole thing, or are there particular things that you will scroll down to particularly focus on?
I look mostly at the risk score, but we do look at some of the other items. To be honest, I think Credit Safe has a way to go in terms of having a mature database. I think that will populate itself over time. So we don't put a lot of weight into, for instance, the credit limit score. We do the underwriting ourselves once we understand the risk score. But we do look at the activity. It gives us information that we may have either missed in the credit app or not seen. But typically, we try to see how they're scored. We want to see what the typical payment beyond terms are. We want to see if they have dollar values that are outstanding for other customers. We do look at OFAC, to see if they're, the enemies of the Office of Foreign Asset Control. Obviously, we want to make sure we're doing some measure of KYC with these customers to make sure that they're not using us, as you said they were trying to use you. But by and large, we weight the risk score more than any other one box that I would see on the credit score report.
Yeah, and then when it comes to doing a credit check on an existing customer, so is it mainly when they go into that 30 or 60-day bucket that happens, or is there something else that would trigger you to do a check on an existing customer?
Typically, they're over 60 and they want to put in another order. And if they do that, we will ask them for payment on the old order before we fill the new order. If it's a large enough customer, Caleb will, our credit monitoring representative, he will go back on and he will take a look at what the credit score is to see if anything's been updated. But I could have a customer on who's an existing customer, who's a 5-year customer who all of a sudden had financial difficulty in the last 90 days. I would not necessarily hear about it if we didn't go in and take a look at an updated credit score. And we do that. So if a customer's filters are on hold, their account is on hold, and they haven't paid us for some period of time and they want to put through new filters, we'll take a look to see, and we do this frequently, this is not infrequent, to see if their credit score has changed or if we think that they've become a higher risk customer than maybe we thought they were when they came on board several years ago. So it's not just for new customers and onboarding that we use the credit scoring. We use it for customers who are beyond their terms and who are still trying to buy filters from us.
Yeah, that makes complete sense. So thank you so much for sharing all of this, Joe. Now I'm going to really quickly talk about something that's not as relevant to you, but is relevant to a couple of industries. So we work quite a bit with the equipment hire or equipment rental industry for them and for, or I would also say for education and some other industries, having capturing payment authorization at the time of them signing up can be a great way of ensuring that you keep getting paid on time. And that is something that can be done through the ezyCollect credit application. So I'm also going to really quickly just summarize what ezyCollect currently has available in terms of credit risk tools for UBT members. So we have a partnership with CreditSafe, and so what this allows is for you to do a lookup on a business. You can request a credit score and a credit report, and it will show, like Joe said, the risk score. It will, if it has trade payment data, it will also talk about average days beyond terms. So if there's a lot of businesses with the same name, you can you'll be able to select the correct one and filter by address. And then when it comes to the credit report, you do actually get a credit report with every credit score. So there's no real reason why you shouldn't get that at the same time as your credit score. But it will go into risk, more information about the risk. It actually contains quite a lot of info about trade payment history, what industries they're purchasing from, how their days beyond terms changes over time, as well as directorship information. And we've just released the digital credit application. So it is an onboarding form that we can design for you. So it would have your branding, would have, you can ask any information that you want. As Joe could probably attest, like we were working with Caleb to specifically replicate the original Jot form application. And even, you know, certain requirements like maybe tax exempt businesses have certain things you might want to ask versus non-tax exempt. So there's a lot of flexibility in this application, and you can also capture payment details if you want. And that is something I know Joe mentioned briefly. He's looking forward to when phase 2 for this credit application is coming out, which is I think it's scheduled towards the end of this year, which is the integration back to NetSuite. So when you approve the credit application, that it will set up the new customer account. So that is coming pretty soon. So yeah, you'll be able to review, approve, reject all the information within ezyCollect. And yeah, so that's the credit risk tool. We do have other tools, as you probably are aware, but we won't go into those today. I know we are getting towards the end, so I'm going to ask any questions.
I think we have one question that's just popped up, which is, how is this process as program different to a platform offering by trade credit insurance such as Euler Hermes Allianz Trade? So how is it different to typical credit insurance?
Well, you're
Can I
probably the
answer?
person to answer that, Joe. Yeah.
Okay. It's not that different. It gives you the underwriting ability, but there's no insurance component to it. So with somebody like Euler or Allianz, you know, effectively you pay a premium, and on top of the premium, you pay for underwriting risk, meaning you pay Allianz or Euler for the ability to do the diligence work and to do the credit reporting. The reason we went to ezyCollect and what we use today has no insurance component to it because we didn't feel that, frankly, it was a user-friendly product that gave us the ability to recover claims against it. So, and we also had a pretty good paying customer base, so we didn't feel like there was a lot of return on the value of the premium that we're paying. But Euler and Allianz charge you for the insurance piece, which is a hefty piece because they're underwriting for insurance loss, and a smaller piece for credit underwriting. We at Brook Air took on the credit risk ourselves, and we do the underwriting in concert with the tool at ezyCollect. And we've been doing it for a year, and it's been transparent. It's not different. We haven't made a lot of dramatic changes that the customer can see. We're probably tighter now than we were under Allianz, you know, in terms of how diligently we look at this. But the platform's a little different in that what we're using it for is doing mostly just underwriting. So
Yeah, thank you so much for that. Any other questions?
I think we have time for one more. This question again is to Joe. Joe, if you had to recommend or give a piece of advice to someone when they're doing credit onboarding, what would your number one piece of advice be?
I think it's imperative not to approve product going out the door until you've got a completed in full credit app. The credit app is the first contract that you sign with your customer that's going to give you the information to get paid. If you start with your first series of orders without enough information to get paid, you're going to be chasing that customer for a long time and frankly antagonizing that customer until you get all the pieces of data that you need so that you can understand, the tax exemption and how they're going to pay and what their days are and how you're going to start aging their account. And, they're going to start aging, and not paying. It's going to be an uncomfortable relationship if you don't front load the information as tightly as you can. So the best piece of information we can give is get your information in up front before you start fulfilling orders. If you can digitize it, it's not that hard to do. We did it with Easy. We did it in both ways. Your customers will appreciate it. It'll save you some heavy lifting and some time. But the onboarding process, customers should understand that your companies have to get paid, and their obligation, is to pay you in exchange for you providing a good product and a good service. So we're a little stricter than that, meaning we sustain that as much as we can. I don't think we're aggressive or militant about it, but if patients go beyond terms, we're calling them and we're pursuing the money and we're holding product until they get current. So we do that because we think that there's both an ethical and an economic reason for them to pay us, and we hope that they abide by that. So,
Excellent, awesome. And then we have one final question, which is, do banks recognize the ezyCollect service in the same way as Euler Allianz for borrowing?
That's an excellent question. The banks take comfort in the fact that you've got AR insurance because it can sustain cash flow in the event of a spate of bankruptcies or dissolutions. What the banks don't understand, I've gone through this with the banks, is that the ability to actually perfect a claim against some of the AR insurers is very, very difficult. You are not insured for 100% of your receivables. You're only insured for what would be deemed good receivables. The banks take some comfort in their underwriting when they're trying to do risk underwriting, when they see underwriting insurance, because it gives them comfort that there's a secondary layer of cash flow in the event that a large receivable goes uncollected. So no, I don't think the banks have the same understanding of the process with ezyCollect and, for instance, Brook Air, who's now self-insured, as opposed to what went on. But they'll look at it something larger than that. The banks with us look at our days in AR. Our days in AR are around 42 or 43 days. We don't write a lot of activity off. We don't send a lot of accounts to collection. We're pretty good about boxing in and getting paid, within the terms. When they see a credit history that is well contained and well managed, they don't need to fall back on the Euler or on the Allianz methodology. But yeah, they do take some comfort in seeing that there is some AR insurance, and it'll take some explanation to get past that.
Yeah.
Excellent.
Well,
thanks for that, Joe.
yeah. Well, thank you so much, Joe, for taking the time to speak with us today and sharing your wisdom. I just wanted to, I know we've gone slightly over time, but I just wanted to tell everyone still on the call, if you're interested, ezyCollect is offering 3 free credit reports and scores to anyone who was here. So if you want to use the QR code, you'll be able to claim that. It does not require any commitment to an ongoing subscription with us, although, I mean, of course, we would love for you to sign up with us, but you don't have to. But if you're interested in just getting some credit reports for free, I highly recommend it. It does contain quite a bit of information. I suppose just to quickly wrap up, Joe, is there anything else that you think our listeners should know when it comes to, I guess, the secret to getting paid on time?
No, I think you covered it. I think, the technology in combination with a good repetitive and recurring process will help keep your receivables current. I think if you follow your process, your AR will stay current. If you start to make exceptions, you're going to have your AR starting to age. So, but you need a tool to do it. We are not professional underwriters, so something like the underwriting tool you're giving us gives us the ability to get smarter about it. But we use your tool in combination with a slow start with a lot of the customers to allow us to gradually increase credit limits over time. But if you follow your process, I think your risk will be managed rather well.
Wonderful. All right. Well, thank you so much. Rohit, Dinali, anything to add?
No, just thank you guys. I appreciate everyone for joining the call today. And special shout out to you, Joe, for really giving us a ton of sage wisdom here. It's been really invaluable. Thank you so much.
You're welcome.
All right. Well, have a great day, everyone, and good luck with your onboardings.
All righty.
Take care. Bye.
Take care, everyone. Bye.